Good morning. I'm Gord Long with the Financial Repression Authority. It's my pleasure to have with me this morning a couple of guests. No stranger is Charles Hugh Smith, well-known, prolific writer on the web, who is the publisher of the website of2minds.com and longtime co-host with me at Macro Analytics. Good morning, Charles.
Good morning, Gordon.
How was the camping?
Terrific.
We also have with us Rick Ackerman joining us. Rick is also a very well-known writer on the web. Welcome, Rick.
Glad to be aboard, Gordon.
I'm really looking forward to having the discussion with you and spending some time here this morning. Rick, maybe we could begin with you just describing or giving our listeners an overview of your background, the things you're involved with.
I'm a trader and forecaster, and I have a daily service called Rick's Picks. I try to put out a few actionable trades each day, and also have a method that I use for analysis, forecasting, and trading, and I teach a monthly course in that. My background going to my roots is in journalism. I was a reporter, and I've written on an occasional basis for Barron's. I had a column in the San Fran Examiner for a while, mostly on the stock market and economic issues.
Well, maybe we should be talking more about the stock market, but we're not going to this morning, after having said that. Rick and Charles, what I was hoping to do, and I want to just jump right in because we always run out of time here, and I got quite a few things I was hoping we could discuss or talk about, but what I really want to engage in is what we might expect from the central banks. There's a lot of speculation going around if they're going to do anything, and I have up here a chart of what might be a possibility, and I stress the word might be a possibility because nobody really knows, that we put together at the Financial Repression Authority of what clearly is in the press now and we've been reading about for quite some time. And I'm just wondering if we could step through those and each of us maybe just give our opinion of what we might expect. And the first one is this discussion of whether we're going to see another round of quantitative easing. Call it quantitative easing 4 or whatever they're going to cause or whatever they're going to call it. Can we expect that? And Rick, as our guest, maybe we'll start with you. Is that a possibility?
Well, always a possibility, but I feel like I've been kind of tugging the argument or trying to tug it the other way. Janet Yellen has been really strident lately about this could happen in December. And I've been, I guess you could say, shouting from the rooftops that the Fed would never raise interest rates. There's a question as to whether they can, since money is already too loose within the money market world to tighten in the way that the Fed intends. But I don't think the economic recovery, such as it is strong enough to support even a small tightening of the screw, even 25 basis points, if the Fed should decide that it wants to demonstrate that it can walk the walk.
Charles? Another round of quantitative easing up in the cards?
Well, it seems to me that one possibility is they go ahead and do the quarter point rate increase because they've built up so many expectations of that, and they may need to do that to create at least the illusion that the economy is recovering. Because if they don't, then it's hard to sell the story that the recovery is, robust. But I'm wondering if there's other mechanisms that they could use to loosen money while they tighten, so that they would be attempting to sort of moderate the effects of that rate increase. That's one possibility.
Let me weigh in on my opinion here on this. Is I think they'll probably get a quarter point on terms of the rates. I don't think it's almost beginning to be baked in. The market may gyrate and drop a little bit, or maybe could be fairly harsh and temporarily, but I don't think that's really the issue. I think the issue is whether we're going to see them come out with another, whether it's Operation Twist, of something of that degree. We're facing pretty close to a recession in 2016. All the signals we look at say it's a very strong possibility. We have a global slowdown that compares very strongly to 2008, at least with everything that we look at. And I do a lot of work with Richard Duncan, Macro Watch, and Richard tracks liquidity flows very closely on a global basis. And his work shows that once we get down to a 2% growth in credit or anything less than that, we fall into a recession. We're there now. And he's been screaming and with extensive work here for about 6 months that if the Fed doesn't act with a new round within the next 3 months, a recession is guaranteed and locked in. Now, whether he's right or wrong, and he's been consistently right here for quite a few years, it says we're bordering on that point. And the other thing that I'm is seeing is the reason I have to push it is the growth in global reserve requirements, or global reserves rather. China's are falling off dramatically. The OPEC countries, Saudi Arabia, are burning up theirs in terms of bleeding because of the current count problems. And unless this money is pumped in, there's actually a dollar shortage. Unless this is pumped into the system, it's going to make it much worse. I think that the Fed is actually going to be forced as soon as we see a crisis begin to loom here, or a threat of a recession. Personal opinion. Any comments on what I just said, or anybody else said on this subject?
You said we wouldn't talk about the stock market, but that's always going to be a wild card. When the drumbeat about tightening intensified a couple months ago, we came into a period in August where the market sold off really hard, and the low on August, the time when the markets were hitting their lows around August 24th, the buzz was that any tightening is definitely it's not going to happen. And to the extent that the stock market really buttresses bullish psychology, we'd have none of it if the market came down for whatever reason.
Yeah, I actually believe the market will be the trigger point. Probably could be a worry of a recession, but when we've seen consistent action from the Fed when we reach certain support levels within the market, certain moving averages, almost consistent, that we'll see it. My opinion, and I have a service called triggers.ca, a technical analysis site for stock trading. And somewhere around 1800 on the S&P is a major trigger point. It could drop much lower than that, but somewhere in there, we believe the Fed will be forced to take some action. But Rick, I'm agreeing with you. I actually think the market may be a real key driving factor, primarily because it's not the wealth effect, it's because of the collateral. Because when these asset volumes fall, they're so highly leveraged right now, not just in the market, but maybe more so in the bond market with rehypothecation, that falling collateral values could be devastating to the market.
I want to raise a real quick point here about the political capital of the Fed. The Fed has still presented itself, and Bernanke, of course, has come out and with his biography or his account of how he saved the world, etc. The point here is, has the Fed burned up its political capital by continuing QE too long? And I think the issue here is it's now being accepted that the Fed's policies of QE and zero interest rates have exacerbated wealth and income inequality. That's become a given. So that's created a constraint, I think, on the Fed's actions that didn't exist 2 years ago, 3 years ago, 7 years ago. So they may be somewhat constrained in just how crazy they can expand money supply because of this general recognition that their policies have really hurt Main Street and have only helped Wall Street.
Comments, Rick, on that?
If you ask the man on the street whether QE is working, you have to go first to the retiree. There's no one who planned for retirement 10 years ago who could have foreseen that $1 million nest egg would not only not generate what you need to take cruises, but to avoid eating cat food. It's amazing. That the Fed should have any credibility at all right now on this whole idea of stimulus the whole idea should have been refuted simply by the fact that savers have been cheated for so long. It's one thing when you see the markets go bonkers and all the mergers and acquisitions guys get their huge bonuses, but when you see who's making huge money and who's eating cat food, it really puts QE in perspective.
It's devastating to the retirees. The damage that it's done on a sustained basis. So if you'd saved, let's say $500,000 and put it away, and that's going to be your retirement, and you have a little social security, and suddenly you're making zero and you're eating into the capital. And that's what I hear so many people saying. Gord, he says, it's not just that I'm not making any money on it, I'm eating my capital, I'm running out of time. And there's a fear, you can hear it in their voice. It's terribly sad. But there are other actions that the central bankers could take. And one that's getting a lot more talk is the old proverbial helicopter money or overt monetary financing. And that is bypassing the banking system and just passing money directly to the public for whatever program, so that it will be a stimulus as opposed to getting locked up and becoming excess reserves of the banks, if I can put it that way. Comments on that? Is that a possibility, helicopter money?
The best perspective I have on helicopter money comes from a book called When Money Dies by Adam Ferguson. And he describes the Weimar hyperinflation of 1921 to 24. And the German hyperinflation essentially was a policy instrument to avoid unemployment. The irony was that Germany had lost the war, but had more or less full employment in the early 20s, whereas the victors were wallowing in unemployment. But what Ferguson describes is a monetization that took place in a literal sense. There were boxcars filled with money shipped out to the major employers, and in this period of hyperinflation, the steepest climb in inflation occurred when the printing presses were literally not working. There were two periods where the printing press operators who printed Reichsmarks were on strike, and Germany had previously negotiated with the major employers the issue of scrip. So when there was no money being printed, the companies went willy-nilly creating their own currency. And today you don't see a mechanism really to put money directly into the system in the way that Germany did. Ultimately, you wind up with helicopter money having to be borrowed into the system. And of course, borrowing has a price. So I think that any attempt at helicopter money would be a non-starter. You simply couldn't do it.
Charles, comments? Matter of fact, Charles, we did a show on helicopter money.
Right.
So we've already expressed some opinions on it, but
Yeah, I'm going to repeat one of the things we covered there, Gordon, which was the idea that maybe helicopter money won't be direct, but it could be indirect. For example, forgiving some of the student loan debt, which is about 1.2 trillion now. So, and the federal government has taken over much of that debt. So if they forgave some of that debt, it would be an indirect form, because the student debtors would be getting a bonus payment, if you will. They were no longer having to pay their student loans. Another possibility of a similar nature is, I wonder if the federal government couldn't do something like simply ignore the student loan debt. In other words, people that are defaulted, instead of being hounded like they are now, it's accepted in a sort of ad hoc fashion that you can default and get away with it. And so that would be another form of this sort of indirect helicopter drop, that people suddenly have more money because they don't have to pay their student loans, and there's no negative consequence to that anymore.
Yeah, and there's, of that 1.3 trillion of student loans, about 600 billion of it sitting in forbearance. That does not default. That's not delinquent. That means they've just been put aside and they're not collecting the money, which means somebody's actually paying for it. So if the money was to go to the student loans, it would just be zeroing out. I don't think it would be a stimulus in terms of that comment. My view on that. And I was paying a lot of attention to Jeremy Corbyn in the UK, and who really swept the Labour Party. And one of his key platforms was the quantitative easing is only for the rich, more or less. I'm paraphrasing. And what we need is quantitative easing for the people. And what he's really talking about is helicopter money. That is, we just need to get it out right directly to the people with some kind of programs that he wasn't clear on which programs, but clearly a lot of the social fabric social programs in the UK are beginning to fail, or at least the pressures there. But I'm watching the elections here in the United States, and I'm listening closely to the candidates. And I'll pick on Hillary Clinton. She's pretty clear to me that she's going to do something with the student loans. There's going to be some kind of forgiveness. So I could see it coming in the United States. But I don't believe any of this would happen without a crisis. Rick, back to some of your point. It's not going to happen on its own. They're going to need cover. So it's going to be a collapsing stock market. It's going to be the threat of a recession, especially if we're going into an election year to drive that. But it could be that it doesn't start here. It could be that it's because we're playing a bit of ring around the rosy with currency debasement between what I refer to as a currency cartel. And so it may start in Britain, may slip into the EU. It may start there or Japan, and we may be the last to come on them, to come out with it. Any comments on any of the other points?
I think the juggernaut of deflation is so huge now that there's really not going to be time to react. I tell my own subscribers to keep a shoebox filled with 5s, 10s, 20s, and 50s, because on that day that might come that we wake up one Monday morning and the banks don't open, you can forget about gold, at least until it works its way into the system. So we're going to need actual cash money. But when you talk about things you could do to inflate putting money into programs, I think it would definitely be, it would ease the household burden if you forgave student loans. But more immediately, you would have a problem with the public employee pensions and healthcare benefits, because that's real money. That's money that gets spent every month. And it's one thing to pump the financial markets full of hot air. It's very easy to inflate financial assets, but it's very difficult to inflate through the mechanism of all these programs, essentially sending out checks each month to public employees. That represents a way to get money into the system, but as you can appreciate, it wouldn't be politically feasible to favor that one class of public employees. Their pensions would be all right, but all the rest of us would have a little problem. So I just don't see the possibility really of massive inflation. There are ways to do it overnight. The government could say, well, we're buying and selling gold right now for $5,000 an ounce. What could be more inflationary than that? But the idea of just putting money into the system, there has to be a mechanism, and unfortunately, the only way to really get that money into the economy is to borrow it into existence, and with the sums we're talking about, with the trillions in stimulus that have been shot into the system, you might just as well have started out several years ago and say we're going to have a moratorium on taxes, no income taxes for a year. That would be a stimulus.
Rick, that's a very good point, and we've already seen a little bit of that in that. Remember the 2% forgiveness in the payroll tax and the Social Security tax. That was a give back to the taxpayer, and so if things got extreme, I could see them canceling or forgiving the entire employee 6.2%, which would in Social Security, which would just be covered by more deficit spending, but every employee would get a 6.2% raise. I want to raise real quickly the model of Japan, because that's the developed economy that's been in a deflationary setting for almost 25 years now, and we can see what they've done and what effect it's had. And one of their favorite stimulus things, as we all know, is building bridges to nowhere, because they have a very powerful construction lobby. And politically, the rural prefectures in Japan still have a lot of political power, which is far outside, which is outsized in comparison to their population. So as a result, Japan has poured, untold sums into building, fabulous roads to villages of like 1,200 people, and that's how they've attempted to stimulate their economy. Has it succeeded? obviously not, although maybe it's kept employment at levels that were better than it would have been otherwise. But they've refused to cleanse their financial system to allow real, investment, and so they've just pursued this sort of malinvestment with borrowed money. So they've kept their system afloat, but it obviously hasn't created a healthy economy. And I wonder if that's not the road that we're kind of looking down.
Comments, Rick?
Japan had something over the last 20 years that we don't have, and that is us. Japan had a global economy to export into, and you might say that the global economy was supportive of Japan. We were the buyers of last resort of their exports. We don't have that, so we can't really turn in the same direction that Japan did. And the domestic example, the analog might be Detroit is doable. We can put Detroit into some sort of bankruptcy where it settles out in a not so terrible way for public workers who were owed pension, pension money and this and that. And but Detroit can only get by really because the other cities have not yet imploded. We see New York is Detroit times 10 waiting to happen, and it happens because you have people, behind the glass windows in subway stations that their package is worth $110,000, and they're going to retire at 90% of their peak salary. So what's happening in Detroit is going to happen on a much bigger scale in Chicago and New York. But Detroit has muddled through simply because the ambient, the surroundings, the U.S. economy is supportive of their workout.
Charles, comment?
No, I think that's an excellent point. And the other thing that we have, I might mention that Japan doesn't have, is a rising dollar. So we seem to have a market that we can sell our debt, our treasury debt into in almost unlimited sums. And it's interesting that I've been a dollar bull, and I think both of you have also been constructive on the dollar for way longer than most people. And so, a lot of people, like, I think about 5 or 6 years ago, there was a feeling in the blogosphere, at least, that if China started selling its treasuries, it would be the doom, of the U.S. dollar, and the U.S. would be forced to collapse, et cetera, et cetera. All of which turned out to be completely false. The Chinese have unloaded as much as 500 billion in treasuries, and there's been no effect at all. So we seem to have that going for us in terms of if we wanted to go borrow another, $5 trillion to fund stimulus, it seems like the strong dollar is going to enable that, for better or for worse.
Charles, to your point on the dollar, and Rick, going back to your comment earlier, and I agree fully with you about how difficult it's going to be to get inflation. It's my opinion right now that we're actually in real deflation. And we got much more to go here. I mean, there's no question there's certain areas where there is inflation. People at the grocery store will tell you. But we basically have inflation going on a fairly broad base globally. And so, what would reverse that? What would suddenly allow us to then turn into an inflationary or a possible hyperinflationary period, especially when you look at things like the velocity of money? It just keeps on going down. It's got to go up before you get into inflation. And, they could there's a lot of things the Federal Reserve can do. We got $3 trillion of excess reserves sitting at the bank, and they're at the Federal Reserve from the charter banks that they're paying 25% or 0.25% to. Now, they could reverse that. They could change it. They could actually make it a penalty and force that money out. That's a lot of money. And I know they could change reserve requirements. There's a lot of things they can really do to push much, much harder on them. Of course, there's real consequences of them. Another thing, I happen to believe that before you'll ever get inflation, it'll be because inflation and real inflation is a currency event. It's a loss of confidence in the currency. So it would have to be a weakening dollar before you'd really start to see it elevated. But I don't see that in short term. I think there's still a lot of lift in the U.S. dollar before it's going to come down. But one of the things Yellen just testified in Congress is about the possibility of negative interest rates. Now, we have 3 to 5 trillion of bonds globally trading negatively. That's already happened. There's a number of places around the world with negative rates. But we've had ZIRP, which is negative real rates with inflation factored in. But she's talking about NIRP, negative interest rates, to force more stimulus. Is that a possibility? And there's more people talking about it. Rick, Charles, who wants to lead?
Rick, go ahead.
I think that when you attack the Fed governors and the chairman ad hominem, you say, well, they're complete imbeciles. Usually it exaggerates the case, but when they talk about ZIRP, it really they're shading into that area where they're blithering idiots. Because if you can somehow extrapolate a positive economic benefit from taking interest rates negative, where would that benefit be and how long would it last, really? The idea is that if people can no longer park money anywhere, that they're going to invest it or spend it, you have to think, well, where are they going to invest it and where are they going to spend it? It's inconceivable. It's unimaginable that money could find it into something in the economy that would cause our economy to get healthy, to grow in a healthy way. So really, when the zero interest rate thing to make it a burden to save money, not that it's already bad enough that you can't save money. You have to sort of put it to work, and you can see how it's working. We've got huge repo markets and multi-billion-dollar markets in esoteric instruments like Bolivian reverse floaters. So to spook money into circulation with ZIRP is that's the height of craziness.
Charles?
Rick, that's an excellent point. You've encapsulated the insanity very well. And I just want to mention, in a current example of negative interest rates, we see what's happening in Sweden, which is actively pursuing negative rates. And it seems, from what I gather, the net result is taking their housing bubble and inflating it even further. And so, the house that's worth 300,000 units of currency was 8, and now it's 1.2 million. And so it's hard to see how that's going to be a positive. Basically pricing everybody out of housing and creating a fantastic credit bubble. And how is that going to end positively? It's hard to see how that could happen. And yet the Swedish central bank is proceeding apace as if it's a workable policy with a brilliant end point.
Yeah, these interest negative nominal rates, the only people that it really helps are the huge debtors, such as the governments that have got huge amounts of debt to finance. Let's assume our U.S. government debt is 18 trillion. We both know that realistically it's higher, but let's say $18 trillion. And right now, if interest rates went up, we just couldn't handle it. So the lower it gets in negative, as many of the European bonds that are sovereign bonds are trading, it's positive in that regard. But it doesn't work, Rick. I completely agree. I can't imagine, but I couldn't imagine quantitative easing a few years ago, and now we got you used to that. But to do it, you'd have to stop cash. You have this what's called the war on cash. It's already underway because people will take it out of the bank. If you're going to have to pay the bank to store it there, corporations aren't going to keep their money there. They're going to have their own vaults, if you would, to handle whatever currency they're going to pay. And I was just reading the other day of Overstock retail. They've got a vault in gold and silver to pay their employees and think that if there's a crisis coming. I mean, I couldn't believe a retailer was taking it to this level. But the problem with the cash is the banking system wouldn't work. Well, the banking system would work, but because right now the biggest concern they have is another set of bank runs. And if you can restrict the cash, you can't get it out of the banking system. The war on cash, whether is there or not, but there are so many examples of where the restriction on cash, not talking about the United States, around the world is being put in place. And it's almost, and I'm not a conspiracy guy, but it's almost coordinated. It's so consistent. There's such a worry. But the bigger problem they're concerned about is another run on the bank. We saw that in 2008 with the money markets and how quickly that money could move. But if you could lock it into the banking system so that you can't get it out, and there's obviously reasons why people don't even believe they need cash anymore, it allows you actually to implement negative nominal rates. So comments? Comments on this war on cash. Is that real?
Well, that the shoebox idea that I mentioned
Yes.
earlier comes. I think you can predict that if you wake up one Monday and the banks aren't open, there's a real problem. We have pictures from the 30s where people lined up outside the banks. They should save their breath this time because, if you go to a branch now and ask for $25,000, let's say, you're going to wipe that branch out. So they don't keep much cash, and the first two people in line outside the bank may get their money out, but that's about it. So from day one, then, if we're forced into a cash and barter economy, you're going to need that shoebox full of 5, 10s, and 20s, irrespective of what you may think about the dollar now. You could say, well, the dollar is intrinsically worth nothing, and that's true. But you're going to be in a situation where if you need to buy groceries, the only thing they'll understand is cash money. So and there's no way, I don't think, that you can reinflate through the credit card system, because whatever caused the banks to not open on that Monday will have compromised the very fragile system of trust that makes plastic money work. The clearing mechanism globally that keeps all those credit cards in play, that involves selling streams of interest payments and principal payments and this and that, it is so complex and so delicate that there would be no credit carding on day one. And if the government were to say, everybody add 3 zeros to your credit limit, you can imagine the havoc that would play. So we're really going to be in a situation of cash barter, I think, if that day comes when we wake up and there's some crisis. Forget about selling your stocks, because what will happen will already have happened in the European and Asian markets. Will be looking at something that breaks the circuit breakers.
Well, we saw, the first time in Cyprus, then we saw it in Greece. The moment the problems got more serious, the ATMs locked down, and suddenly you were allowed $100, $200 a day. How do you live on that? And all of a sudden, it was just instantaneous. And now with bail-ins in the banks, if the banks get into trouble, your money's there. You're the one that's going to surrender the cash as they bail out the banks, and you can't get it out. So to me, you better have cash available, Rick, and you come in a shoebox. But I've actually tried to take cash out of a bank. I don't know if you gentlemen have tried that. But even anything around $2,000 in cash, they treat you like a criminal. The forms that you have to fill out to get the money out, you got to almost tell them chapter and verse what you're going to use it for. We were stunned. We just could not believe this was going on. Ever mind if you walk into the bank and say, "Hey, I got $3,000 in cash I want to deposit." Immediately, you're laundering. You're a drug smuggler. Okay, so cash is not something you want to walk around a bank with anymore.
Guys, I want to raise this issue of the war on cash being a potential trigger for political resistance to the central banks and the central state, and the basis of that idea is that as the economy stagnates, we all know what happens to the working class and the people who've been kicked out of the middle class by medical emergencies or lost jobs or mortgage defaults, all the things that have been become standard, is they immediately realize their only way to maintain a decent lifestyle is to enter the cash economy and start trading things for cash or selling a service for cash. And so so that's called the black market in other economies. And the black market is, of course, the only part of the economy in highly restrictive economies that's flourishing. And I think that maybe even be true in the United States as well. But it's certainly true in Europe, where, like in the south of France, where my brother lives, roughly 40% of all construction and so on, if not higher, is all black market. I mean, you're pushing 50% of actual activity is black market, right? Cash, because no one can afford all the taxes and fees and all that other stuff. And so as that happens, then if you do try to declare cash illegal, you're going to be basically impoverishing some significant percentage of the working class who now depends on the cash economy. And this class has typically been politically passive. They don't even vote. You know, they're out of the loop. They're powerless, and they're trying to work around it. But if their livelihood was eradicated in one fell swoop, then maybe that would radicalize them. And that would be something that the political establishment is really not prepared for.
Rick, what do you think's in the future here? We've talked about a number of policies here. Are there other policies you think we might see from the Fed, central banks in general?
Well, you can see that policy is really driven by crisis. If there's no crisis, then whatever policy we have is completely ineffectual. That's why Congress is polling now at 13% favorability. No one thinks they're really doing much. And my fear is, though, that the onset of crisis will be so precipitous that a solution will be impossible. It's really going to happen very quickly, and it's because the incipient deflation out there would be fed by a derivatives bubble, essentially a huge, thinly collateralized edifice of credit. It would implode so quickly. I think it would happen overnight, really. And when you talk about, well, we see inflation, of course, in college tuition bills, which are fed mainly by the student loans. And we see what I call lettuce bin inflation at the grocery store. But if you take the dollar sum, the impact of those higher grocery prices on all households, and you subtract out what's occurring right now in the futures markets, you subtract net household inflation in the lettuce bin, you offset against that the implosion of commodity prices. Gold, which has come down $100 off its recent high, crude, low 40s now. I think it's going to 29. Well, those are the big deflationary numbers, and they completely dwarf anything that we experience in the way of rising prices.
Charles?
Yeah, I totally concur that, I mean, this deflationary wave is so vast, and we see so many bits of evidence. The shipping rates are collapsing, and for example, and I do want to ask you, Gordon, if I may, to speak a little bit about your idea of collateral guarantees, which is a topic that is outside the mainstream, I think. So maybe if you could explain how that would be a mechanism the Fed could turn to.
I think that's in the cards in the middle of the next crisis, and let's say that's somewhere in 2016, 2017, and it goes back to what you were alluding to, Rick, with the derivatives market. We have a approximate of $500 trillion swaps market that's underpinned with collateral that's our bonds and currency, but bond market. So if bond prices or values were to drop, that is a horrendous issue. We have a $72 trillion shadow banking system. The global economy is only $72 trillion, and it's all based on borrowing short, lending long, and it's all securitized our securitization products, such as mortgage-backed securities, asset-backed securities, which was the central problem, as we recall, in 2008. Again, collateral. So we were able to stop the 2008 crisis. I didn't say we fixed it. We were able to stop it. I don't believe we've done anything to fix the problems. Shadow banking system is just changed names, but they will be forced. And when I say they, not just the U.S., this time will be, Rick, at your point, a global issue. And I believe that the central banks will be forced to come in and start guaranteeing these collateral values. That's why my comment earlier in the stock market is down 1,800, 1,400 on the S&P. We have a huge pool of ETFs out there that have exploded in the last few years, and they're bond ETFs. So it's easy to click and sell your ETF and bonds, but somebody's got to sell those bonds, and they're not easily transactable. We used to have banks being market makers in it. They're no longer there. So even to be able to fix or stop or get the system stable, the central banks will have to come in and guarantee in a massive, massive way. And I believe there's a lot of players that are betting on that and are willing to take risk-adjusted positions, knowing that basically there's an arbitrage that'll happen at some point in time. I may be overstating that, but the crisis is there. Comments on that, Rick?
You got to be awfully smart, really. I think that
yeah, or awfully stupid.
well, when I look at where the big money's going, you can see that some of the really smart guys, BlackRock and their ilk, they're getting crushed right now. You
Yes.
have guys like this William Ackerman, no relation, who's taken a huge hit in Valiant. Well, the only way that an individual can come in a way of putting billions of dollars into some drug company is with money that can be borrowed almost for nothing. So that's the kind of collateral you're talking about. That Valiant has this huge multiple, and some of the big guys have piled in. But when you look at the whole field of big money players, it feels like only Buffett is getting. He's going down the right track. He bought the food chain with Heinz, which bought Kraft, and he bought the railroads and the right-of-ways, and his investment portfolio is so basic, but it almost leaves. By the time he's gotten there, there's no good stuff left for the other hedge funds, and you're starting to see these private equity funds that were chasing absurd yields and that were getting involved in $50 billion valuations for companies like Uber. That's what they're all in. So when you talk about collateral, there is no collateral. The whole quadrillion-dollar edifice of derivatives is almost uncollateralized. We've got real estate, and we've got our ability to produce income, to produce goods and services, and that's it. But I'd be interested in if you would flesh out a little bit, Gordon, this idea of collateral. Where would it come from?
That is there's a concept called rehypothecation, and that is if you pledge your car, when you get a loan on a car, you pledge your car, and so that's the collateral for it, the residual value of the car. But that car in the banking system now is pledged multiple times as an asset or as a collateral for other kinds of loan, to exaggerate. But that's what's rehypothecation, and it's been going on in a dramatic basis as we built up all of this collateral through the system. So how do we shore it up? You've got to create the collateral. You've got to create some kind of wealth. Wealth has got to go out there to shore it up, and the government is the only one that can actually attempt to do that, or can do it at some point.
That rehypothecation, it's worse than that car.
It is actually.
That's been hawked 6 times. A lot of borrowing and leveraging shifted into the rehypothecation because that's where the action was. It was mostly in London markets that were less regulated than U.S. markets. So when we had the real estate bust of 2007, 2008, we needed something else to pledge as collateral. And as I understand it, the rehypothecation reaches the point where a brokerage account that you have that downstream of it has money that goes into 3 or 4 other accounts or even 10 other accounts. That's all rehypothecated like a daisy chain. But if you close your original account or your account is liquidated, it doesn't cancel out the 5, 6, 7, 8 rehypothecated entities that were downstream of your money. So it's less than zero collateral that exists. And when you look at the whole quadrillion-dollar enchilada, I think the gross figure, rather than somebody would say, well, it all nets out. The actual size of the bubble was only several $100 trillion, but in reality, the gross amount is something that each and every person involved in the daisy chain thinks it gives him a claim on a particular asset. So if something is 10 times rehypothecated, there are dependencies each step of the way on that sum. So I think we're really talking about a quadrillion-dollar bubble, and the very elemental question arises: why do you need a quadrillion dollars of borrowing to support a global economy that's only $70 trillion big.
Precisely.
And that this counterparty risk. We've heard it's always when there's a crisis, that's the issue. And the counterparty is whether their collateral is there, whether the obligations, whether they can fulfill it. And we go back and look at the dot-com implosion. The big casualty just after that was Enron. We remember, and because of the leverage that they had put into the system, and then a collapsing collateral, and suddenly, poof, they were gone. 2008, 2007, same thing. Lehman, but it was different. It wasn't in the oil sector. It was in the financial sector. Lehman and Bear, what was their problem? Excess leverage, and then how it was secured or not secured properly. And right now we're watching in the commodities market. The shale oil is a good example with the high yield bonds, but Glencore could be another canary in the coal mine, highly leveraged, and we've seen them collapse. And so the breaking down of commodities on a global basis is eroding dramatically collateral values across the world. Ever mind those, for example, in China, that were using copper and a lot of the hard metals to finance their business and using those as collateral. So the underpinning is dropping. And Rick, back to your point. So who comes in to bring in the collateral? I don't believe the collateral is there. It can only be guaranteed. And the only person that is capable of guaranteeing it is are the government entities. If we believe that in the full faith of the governments to do it, do I think they'll end up doing it? Yes. Do I think it'll work? It'll buy some time, because as my comment on your government can't create wealth. You can only build it, you can mine it, or you grow it. You can't print it. And collateral is wealth. Collateral is actually productive means in the capitalist system that allows the borrowing, and all debt needs collateral. So printing money creates liquidity. It does not grow that collateral base. And when it falls, and Rick, and as you said, money can only be lent into existence, correct? So when you start to bring it down, it implodes on itself. So I'm not sure I've answered your question, other than to say it's the government.
I want to raise an issue here that I know each of you have covered many times, which is, what does the individual do in this kind of environment? Whereas, as Rick said, why do we need a quadrillion to support an actual economy that's a thin sliver of that? So what the individual has to do is kind of follow, I think, what Rick said was Buffett's thing, which is own real assets, have no debt, because whatever financial wormhole we're going to go through, if you own some tools, the tools will still exist after we get through the wormhole. Real estate will still exist, land will still exist, and if you've built up social capital in the form of you're a tradesperson or a person who performs a service, and you're trustworthy in your community, your reputation and your skill set will still come through the other side of that wormhole. But all the stuff we've been describing will not come through the wormhole.
Now, Warren Buffett, we did a show with Ty Andros on the indirect exchange, and Ty articulated quite well in about 30 slides how well and brilliant Buffett is in practicing the indirect exchange, and basically taking paper, that is his whole insurance side of the business, where he's using values that can depreciate, that are cash flowing significant profit, and taking all of it and plowing it back into real hard assets that will sustain itself, like railroads, like food products, at a fair price. And he's done it so consistently for so many years, and it's why he balances what Ty refers to as paper products, insurances, bonds, structures, and against real assets. And whether Ty's right or wrong, Buffett's certainly been a consistent winner without question. Rick, comment?
He's also resisted the temptation of going after the huge, easy money. His money is not in Uber, it's not in Dropbox, it's not in Instagram, and you can see that's not going to end well, not only for the companies, but for a whole city. If I were going to short any city in this country, it would be San Francisco. I lived there for 20 years, and I love the city, But you see, if you walk down Valencia Street, you see everything is so pumped up, and it's pumped up because there are companies that hire these people that are so egregiously overvalued. So Buffett has shown amazing restraint, amazing discipline in going after the nuts and bolts instead of the sexy companies that are carrying enormous multiples, that are so overpriced. You look at a company, an S&P company that's in business, they've been in business for 100 years, and they have a capitalization of $2 billion, and here's Uber, a business model that is still hasn't sorted itself out, and it carries a $50 billion valuation. It's insane. So Buffett he's concentrated on pickles and ketchup, and Geico, the insurance business, and this and that, and he's really the greatest investment story.
Real cash flowing business with a moat around him, as he calls it. And for those who remember the pre-dot-com implosion, Buffett was pummeled continuously because he just would not invest in the high technology. He said, I don't understand it. The multiples don't make, and he wouldn't touch it. So when stocks were all going up pre-1999, he wasn't there. 3 years later, he looked like an incredible hero. But that's a consistent pattern. So he's found that, I'll use the word hard assets, but real businesses with real products that have a sustaining capability in good times and bad are your best long-term investments versus speculation. Charles, you wanted to say something.
Yeah, I just wanted to raise the issue of risk. And what we're talking about here now is how do we deal with the kind of systemic global risks that you guys have described so aptly? And I think the average middle class or upper middle class American with a 401k and so on is really the risk has been misrepresented to that person in that conventional portfolio management tells them, well, you just, 10% in precious metals and, 40% bonds and 40% stocks. And, you're as if financial assets the risk can be eliminated by simply owning several different kinds of these incredibly risky financial assets. And so that's what we're talking about is we're trying to help people make a realistic assessment of the global risk that they're engaged in if they have a 401k that's heavily in these financial instruments.
Yeah, Charles, I feel quite strongly. I don't know why the options today needs to be whether it's stocks or bonds, or that is you're in an exchange traded fund. I don't get it. And the reason I say that is because the markets are so correlated that you cannot find uncorrelated assets. So when the markets start to move, all stocks, all credit instruments, everything seems to will move together. So the risk, and we are being forced into higher risk products without question, that the risk reward is questionable. So, but then the question is, well, where do you put your money? And that is a difficult one because, things like private placements, you've got to be an accredited investor. So that really restricts what people can do. Comments on that?
Rick,
as a trader, Rick, what do you think?
Wanted to go back to something that Charles mentioned about falling back on our resourcefulness. And I know, Charles, it looks like you could go in a lot of different directions. You might even be an entertainer at a cafe, certainly a blogger extraordinaire. But I'm concerned that we've all sort of gotten away from the basics, and that the economy has so many specialized jobs that if we were to go back to the basics, we'd have very little to fall back on. In the 30s, in the 30s depression, right before we went into the depression, about a third of the American population was involved in the agricultural economy. But I'm just wondering where you think we would go in a post-collapse economy, or how as individuals we would cope. What would you foresee?
Yeah, I think you're right, and this is the importance in the blogosphere of what used to be called survivalists, and now it's called preppers or preparation. And the idea here is that we, as a household and as an individual, we need to recover some of those basic skills, such as being able to grow some food, raise some animals, fix stuff that's broken. And so I think there is a healthy movement in recovering some of those skills, which I should mention were considered conventional and very basic in the counterculture of the late 60s and early 70s. And the counterculture is typically derided as, dope smoking hippies, but the underneath that kind of surface, there was a huge movement to learn how to sew, learn how to, back to the land, learn how to fix your own automobile. And so that kind of movement being in the news now and people are pursuing it, I think that's one healthy answer is get more self-reliant and become more resilient.
Guys, we run well past our hard line here. We have to break. There's much more to talk about, but any closing comments on anything that we've talked about?
Rick, can I start with you?
Yeah.
Well, I think that, to go back to what Charles was just saying, you can't look at what is in prospect as hypothetical. I think if you don't think there's going to be a collapse, then you don't understand the problem. There's no way we can continue to muddle on. For one, it's taking a lot more debt to create that dollars worth of GDP growth at the margin. So I don't know whether we're still the lunatic fringe for most of the people who are out there listening, but it's not a hypothetical thing. I think we're really going to face a day of reckoning, and I would say that the most important thing that we've talked about is the idea of being ready for it and being resourceful in our own lives to deal with it. It's going to happen.
Charles?
Well said, Rick. And there's a lot of different ways we can become resourceful, and there's a whole basket of skills that will and hard assets that will come through that wormhole that we're talking about. And the wormhole is, of course, from physics, where this enormous supernova of debt is going to implode, and whatever's left will not be a financial instrument.
I am actually quite optimistic. I think there's a very serious problem that's long overdue that has to be addressed in the next 7 to 9 years. Could be the toughest years that we've ever experienced as we go through some really major rebalancing. But this is nothing. Crisis is nothing more than change trying to happen, because we have so many major global imbalances. We have political, financial, and economic systems that are not correct, not working, and we're still running from a Bretton Woods kind of post-Second World War model that needs to be readjusted. And in this process, malinvestment, mispricing of risk, lack of price discovery needs to be reset, because typically in a recovery or recession, that's what you do with resetting, but we don't do that anymore. So we need to get through it. But on the other side, for those who have really prepared themselves and weathered this storm, I think the world's going to see its greatest years. The advancements in technology and so many endeavors is staggering. And we have technology that allow to harness more people. So I think 15, 25 years out, it's going to be an incredible time on the globe. But meanwhile, we're going to go through a fairly difficult time. But there will be winners and there's going to be losers. But the winners are always the ones that prepare. So my opinion. Guys, I'll start with you this time, Charles. How can our listeners learn more about your work and your fantastic writing?
Please visit me at of2minds.com.
Rick, yourself.
I'm at rickackerman.com. Publishing is Rick's Picks.
Thank you very much. Sorry to cut it off, but we have to have you both back again. Talk to you.
Thank you.
Bye-bye.
Thank you.